one change to the panel. Is that
right? Okay, well, yeah, we'll get going. So, good morning. Welcome to this Conservative Home Fringe event held in partnership with City UK. I'm Paul Goodman, editor of Conservative Home, and we're going to be discussing driving growth across the UK, very topical subject, with a slightly more limited scope of the role of financial and professional services. I apologise about the noise outside, but believe you me, it's nothing to what we had yesterday afternoon, and we can cope with it relatively comfortably. So first of all, I'm going to go to my old friend, Teresa Villas, who was Shadow Chief Secretary to the Treasury when we were on the front bench team together in the 2005 Parliament. Teresa, MP for Chipping Barnet, former Secretary of State for Northern Ireland. Welcome, and it's over to you.
Thank you. Well, it's great to be joining Conservative Home and the City UK on another quiet day at the Conservative Party conference. And I'd like to thank the sponsors, City UK. I'm delighted to reflect on how we use financial services to deliver growth. This is, of course, a sector which supports jobs well beyond the city in Canary Wharf. My time as Northern Ireland Secretary, for example, makes me very much aware of the importance of this industry in Belfast, but I know that it generates prosperity in many towns and cities across the United Kingdom. And it is crucial that we reform the financial services regulation which we inherited from the European Union, because I believe very sincerely that we can continue to deliver the highest standards and highly regulated markets in a way which is more proportionate, more rational, and better suited to our domestic circumstances than the retained EU law we have on the statute book. And having spent 6 years as a member of the European Parliament working on the Financial Services Action Plan, I can personally attest that the EU legislative process can produce results which are, to say the least, suboptimal. The haggling and horse trading too often has led to legislation which is insufficiently targeted and leads to unintended negative consequences and unnecessary cost. And the report I co-authored as part of the Task Force on Innovation, Growth and Regulatory Reform established by the former Prime Minister, in that report we set out some key principles for a fresh approach to regulating financial services. We advocated a strong focus on outcomes rather than so much tick-box compliance with vast volumes of detailed rules, a shift to a principles-based approach, and the restoration of common law principles. Over our years of membership of the EU, the common law approach was eroded by the more prescriptive methodology of the European Napoleonic Code systems, but the pragmatism and flexibility of English common law makes it the legal system of choice for many around the world, including some highly successful financial jurisdictions. And I think restoring it at the heart of our regulatory process could give London a significant boost in competing with other centres. And the Tigger report also focused on the importance of trialling and testing new approaches and new products, something, again, which was very difficult to do with the inflexibilities of EU law. Regulatory sandboxes which allow new products to be tested in a controlled environment have the potential to dramatically speed up the journey from idea and innovation to established market success. I also welcome the moves the government's made on reform of Solvency II. It was good to hear the Chancellor confirm that reforms will be brought forward to the regulatory charge cap to give pension schemes the clarity and flexibility they need to be able to start to invest in the UK's most innovative businesses and startups. That reform alone could see billions more productively invested in projects to boost the economic growth we all desperately need. As a long veteran of the struggle over MiFID I in the European Parliament, I'd like to see changes to MiFID II. Many of the fundamentals of the MiFID regime have validity and we'd want to keep, but introducing more flexibility and regulatory discretion on matters such as position limits could be a further boost to our financial services sector, and overall a more flexible and modern approach to the regulatory climate for fintech, I think, could also be hugely beneficial. That means making real changes to GDPR to ensure that it continues to protect everyone's personal data, but does so in a way which is less cumbersome and does less to inhibit innovation and competition. And I think while on the subject of data, I have to acknowledge the importance of balancing our regulatory ideal outcomes with our international relationships. Of course, there will be compromises we have to make whereby what might be the best option for us might be tempered to ensure that it doesn't make it harder to access overseas markets. But if we get this right and get on with the regulatory reform Brexit finally allows us to take on, the financial services can be an even stronger engine of economic growth and prosperity than it has been in the past.
Teresa, thank you very much. I'm going to go straight to Dr. Gerard Lyons, as Chief Economic Strategist at Net Wealth, and who you may well have seen on the media in the last couple of days talking about the advice he gave to the government recently, not all of it taken. And of course, the most important thing about Jerry of all is that he is a Conservative Home columnist and will be off after this to write his column. So, Jerry, welcome.
Very good.
Over to you.
Very good. It's lovely to be here. I should say at Net Wealth, we're a discretionary wealth manager. I'm a shareholder as well as strategist there. And just because we're talking about the city, I'm also on the board of Bank of China in the UK and the board of BGC, the interdealer brokers. I'd like to make three comments. First two, relatively brief, and third, given the time, a bit more detail, but still leave lots for the Q&A later. In answering the question, I think it's important to stress that the city and financial services need to be competitive in their own right, as Teresa's touched on, in an intense internationally competitive environment where New York looks set to pull ahead of London, where post-Brexit firms in the city are now facing a politically motivated regulatory environment from the continent. For instance, reverse solicitation, a legitimate way to service EU-based clients who want to be serviced out of London. It's effectively been, shall we say, I won't say outlawed because that might be stretching it too far, but frowned upon and now not being used. So even the legitimate is no longer legitimate in terms of the relationship with the continent. Important things that are overlooked. Obviously, the city itself creates many high-paid jobs in London and across the UK. It boosts the exports of financial services, and if the firms base themselves overseas, it boosts the interest, profits and dividends that come back to London and effectively boost tax. So often the simple bit about the importance of the competitiveness of the city itself is often overlooked. It's a key part of the UK economy, not far short of being 1/8 of the size of the economy. But the second point is that clearly it needs to not only become competitive, but we need to focus in the next phase of changes on how the city can better serve the rest of the UK. This has been an issue since the 1931 Macmillan Gap identified it as a problem. In 1931, a Macmillan report pointed out that many small firms in the UK were not being provided with the banking finance that they needed. 9 decades later, it still is a problem. In 2019, the Bank of England, in its response to its Future of Finance report, mentioned briefly, in passing, without even drawing attention to it, that the funding gap then, in their view, was a massive £22 billion. They didn't use the word massive, though, and indeed no senior people at the bank seem to think that that sort of funding gap was an issue. I think it should be central to some of their discussions. But it's not just that that's a problem. As has been identified, patient capital, that's the availability of long-term finance for growing innovative firms to scale up, is an issue. And as Teresa's mentioned in Solvency II, it's about releasing funds to invest in infrastructure, although one needs to change the definition of what can be invested in as we deregulate on Solvency II. So the first point is the importance of the city becoming more competitive in its own right, and second, the importance of recognising the role it can play. Third, what needs to be done? Look, in my view, Competitiveness of a financial centre depends on the breadth and depth of markets, on the place clients want to do business, and on the regulatory environment. All three are mutually reinforcing, all are important. After the 2008 global financial crisis, the phrase I've used is the regulatory pendulum swung from one extreme to the other, too light pre to too heavy after. Although, as we've seen, it became very cautious in terms of bank sector, but as we saw last week with pension funds, risk in the non-banking sector is there. In fact, what we've seen, I would say, since 2008 is a concentration of risk in different parts of the industry. But the important point in terms of this morning's debate is that the regulators effectively became very cautious. The ghost of 2008 lives on. Then post-2016, the regulators took on a lot more responsibility as EU-type regulation came back to the UK. Now, I think we should be conscious of overloading regulators with too many statutory obligations and potentially overlapping competencies. But the challenge is this, that we do need to streamline things. For instance, the FCA has 3 objectives, it has 8 principles it needs to follow, and it has 7 just regards with respect to government policy. So it's far too complex. If we have too many subjective and discretionary regulations, it's hard to hold any regulators to account. And if there's a sort of lack of clear ownership, basically if they all have the same objectives, we can't really see who's in charge of different areas. So that's the difficult environment we're in. The regulators basically are still cautious and they have too much to do. And also, this is very much seen in terms of how they respond. As in the leadership campaign, it was announced that the current Prime Minister wanted to deregulate Solvency II. The chief regulator in that area said, well, we will have to tighten regulations in other areas for no apparent reason, as far as I can make out. The challenge is there, but the opportunity is this, that post-2016, we have the opportunity to have a bespoke regulatory environment that makes the city very competitive and in turn will actually start to remove the hurdles to the city providing finance for the rest of the country. However, in the first 3 years after 2016, the city was treated with benign neglect. Then the focus was on equivalence at all costs, but as even the House of Lords EU Regulatory Committee earlier this, or EU Foreign Affairs or Economic Affairs, I'm not sure. It was one of the EU committees. Miles and I spoke to it. Even they said, basically, let's give up on going for equivalence. So what do we need to do then? Well, Hills and Austin, 2 good reviews. In fact, they're 2 of the main reviews on financial regulation post-Brexit, said that we have an overarching theme, basically, that the UK needs a regulatory environment that effectively works in practice as well as in theory. Their point is it works in theory, but it never works in practice, partly because the regulators don't give any due weight to competition, the regulators are too cautious, and basically the environment is too complex. Ironically, the EU has been quicker to reform MiFID II and Solvency II than the UK. What do we do, just to conclude? I think we do need a new approach with government support. We need to have call-in powers to counterweight the powers of the regulators, and we need to make competition centre stage in terms of what the regulators do. We've basically equated a sound regulatory environment with being cautious, as I say, whereas we need to look at the outcomes and the effect regulation has, not just in making the city more competitive, but in terms of removing the hurdles for city-based firms to actually do more to lend domestically as well. Thank you.
Jerry, thank you very much. It's very interesting, and there's something I want to ask you about it later. But before then, it's over to Miles Chennick from our sponsor, City UK.
Thanks very much, Paul. So the theme of not just this meeting, but the theme of this conference, and I would argue the theme of this government, it would appear, is about driving growth. So it feels like this is a very timely discussion. And it's something that is fundamentally at the heart of the contribution that the financial and related professional services industry already provides to the UK. So the question is, what is it that the industry is providing, and how can it continue to be an enabler of growth elsewhere in the economy? Because I think what is sometimes forgotten is it's not just the growth and economic activity, substantial though that is, as has already been pointed out on this panel, but it's what it makes possible as an asset for the rest of the economy. So looking at it in a number of areas in terms of what we're providing already and what we need in order to boost that contribution further, a couple things I would just point to is firstly the role of talent. So the single biggest contribution that is made to the industry in terms of what it provides to the rest of the economy, but also the sort of hothouse effect that exists. You've got 2.2 million jobs in this industry, 2/3 of which, by the way, are outside the M25. So it's always important when we think about the city that there's both the geographical city, but there is, if you like, the conceptual city, the financial and related professional service industry across the UK. When I always find that when I sort of share that statistic with people, they say, "Ah, yes, but that's just back office jobs, you know, that's just call centres, whatever it may be," and that's simply not the case. You know, half of the exports of this industry, and something we shouldn't lose sight of, is that the UK industry is the most successful exporter of its kind anywhere in the world. So we export more financial services and professional services than the next two countries, most successful countries put together. So it's a huge asset for the UK. And half of those exports, as I say, come from outside the M25. If you just look at this constituency, Birmingham, Ladywood, there are 20,000 jobs in financial and professional services here. Birmingham itself has 52,000 jobs, and that is constantly replicated in and around the entire country. We've already talked about Belfast and the role that is played there by companies such as Citi and others as driving skills and driving growth and driving investment. On the tax take, and it would be, I think, remiss of me not to point out that the industry pays £90 billion worth of tax. So that's about twice the defence budget. So it's the contribution that we get from that. But also it's the somewhat intangible thing. I used to work for a couple of companies, British companies with substantial operations outside the UK. Particularly in Asia, and the extent to which UK financial services is seen as an element of soft power is something that I think we sometimes forget. In the polling that we do, it's seen both internationally as something that Britain does really well and something we should be proud of, and something that communities up and down the country feel actually we should be proud of. We've got a very successful industry. It's a British success story, and I'm not sure we always make enough of that. So we're making a big contribution already. What more do we need? Well, Gerard, I think, and Teresa have already touched on this, and I would just recommend for those of you who haven't seen it, Gerard's Policy Exchange report, which I think has a number of fantastic recommendations about how we drive the success of the industry. But a few points just to raise. For all that I've just said, notwithstanding, the UK is in at the moment, a period of relative decline. Gerard's already touched on it. The gap between us and New York and the US industry is growing, and it has been for a bit of time. So we need to be able to recognise that we don't have some God-given right to success. If this industry is going to be successful, if it's going to contribute to the UK's longer-term success, we need to make sure that we are driving that success and contributing to that success and working with government and regulators to ensure that continues. So a few thoughts, a few modest suggestions about what might be done by this government in the years ahead. So firstly, there's been a lot of talk, which I won't comment on further, about tax rates and specific levels of tax. And that's often where the debate is, but actually it's a much wider issue. So the UK is not seen as a simple or streamlined place when it comes to tax. We are seen as having a complex tax code. Our major international competitors tend to have much simpler, much more predictable, much more stable tax codes. I thought it was interesting that the mini-budget chose to abolish the Office of Tax Simplification. Now, one could argue that the Office of Tax Simplification perhaps hadn't done as much as we would like. I think that would be slightly unfair on the OTS. There were some really good people there. We're told that will now be at the heart of the work that Treasury does. It would be interesting to get some more detail on precisely how that's going to happen, because that is, it's difficult, it's not glamorous, it's not the sort of thing that gets headlines, but that will make an enormous difference. International companies will look at tax and how tax is run and the cost and bureaucracy that comes around tax, and that can be a disincentive for investment in and of itself. People is the next one. I've already talked about the importance of talent. London is the biggest single concentration of high-skilled jobs anywhere in the world, 1.7 million high-skilled jobs in London. Next biggest centre is New York with 1.2, 1.3. Again, we can't be complacent about that. What are we doing about making sure we're attracting the right people to the UK? I think there have been some very welcome proposals and some very welcome moves on that. But also, how are we growing our own timber here in the UK? How are we making sure that we're reaching into communities that don't particularly always look at our industry or similar industries as somewhere for them? How do we drive closer cooperation with our key markets? The US has already become our largest single export market. It's overtaken the EU as of a couple of years ago. How do we continue to grow that? How do we continue to grow the high growth markets in places such as Asia, Africa, and so on over the longer term? So I think that's a really important element for UK diplomacy and economic policy. And then finally, how do we make sure that we're leaning into the future of the industry? So there's a lot of talk about which regulations we can drop and which regulations we can get rid of from the days of the EU. That, to a certain degree, if we're not careful, is driving whilst using the rear-view mirror. Teresa has already touched upon the importance of fintech, the importance of green and sustainable finance, data, digitalization. This is the future of the industry, and the international centre that gets it right and is the first and develops a leadership position in those areas is going to be the international centre that wins in the 21st century, and that really ought to be Britain.
Maz, thank you very much. And finally, over to Michael Collins, who's the Head of Government Affairs at M&G.
Thanks very much, Paul. Good morning, everyone. When invited to speak on a panel like this, it's always tempting to suggest that financial services as an industry is absolutely central, critical to the whole growth story. And to the extent that we are, it's only because of the partnerships that we have with other players in the economy, with other players in society. And I'd like to spend a few minutes just running through, for a firm like M&G, what those partnerships look like and how those partnerships contribute to growth in the UK. The first partnership that matters is the partnership we have with our employees and with the communities of which we're part. By paying the national living wage, by offering apprenticeships, by recruiting, retaining and constantly reskilling the people that we have got, we're able to make a really significant contribution not only to the success of our own company, but to the life chances of people that pass through the firm during their career. But it's not just our own employees with whom that partnership matters. We also engage, as many firms across the financial services industry do, with the communities of which we're part, offering training programs to kids in parts of the country that perhaps have never dreamt of a job in the city, never dreamt of a job in financial services. Partnering with schools, partnering with charities and community groups like the Talent Foundry enables us to raise the ambition, raise the aspiration, raise the expectations of young people across the country. The second partnership that we engage in that's, I think, critical to the growth story is the partnership that we have with our clients and customers, whether they be the biggest institutional clients or the millions of retail customers that we've got across the UK. Helping those clients, those customers to manage risk, to achieve diversification is really critical. And I think in the retail space, one of the great contributions that the asset management industry can make is helping to get some of that capital that's locked up in cash, locked up in bank savings, put to use in products that are going to give higher return to the individual and make a greater contribution to the productive capacity of the country as a whole. The third partnership I'd mention that's critical for growth is the partnership with the companies into which we invest. Now, at its bluntest, that partnership is about the provision of capital. It's about the growth capital that we've provided at M&G to Oxford Nanopore, the vaccine producer, about the investment we've made in Northern Gritstone, the project to link together a range of universities across the north of England to help them to commercialise and develop some of the research that is going on in those institutions to achieve its full commercial potential. And the provision of that capital to companies large and small, to entities in the public sector as well as in the private sector, is a really critical part of the growth contribution that financial services can make. But it's not just about the capital, it's also about the active engagement that we have with the companies into which we invest. M&G is a very large investor in private assets, which means that we're not only providing capital to those businesses, we're providing hands-on support, helping them to grow. One of the critical stages in any entrepreneur's commercial life will be when they make that step from being an organization that's small enough to be managed by the founder to professionalizing and growing and acquiring all of the panoply of responsibilities that come with being a large company. And as a private asset investor, in addition to providing the capital, we're also providing that support and assistance as well. The final partnership that is critical is the partnership with government. Sometimes government's a client, public sector is a client, as I've already mentioned. We're big providers, for example, of capital for sustainable housing projects and social housing projects across the country. But very often that partnership is really about the public policy framework. Our ability to fulfill those other partnership responsibilities that I've talked about is fundamentally based on a public policy framework: regulatory, fiscal, macroeconomic. Now, it's common to think that what the city wants is deregulation, that less regulation is better. And there clearly are, as people have already said on the panel, some very specific areas where we do need regulatory change and regulatory reform. But I think that's the watchword. It's change and reform rather than necessarily deregulation. And there are certainly areas, and I would look, for example, at sustainable finance and ESG, where the UK's ability to compete in this growth sector, where the UK's ability to become the sustainable finance centre of the 21st century will depend critically on us putting in place a regulatory framework. Because if we don't put one in place in the UK, we will all have to rely on somebody else's. Of course, there are aspects of the current regulatory regime that need to change. I think I'm contractually obliged to mention Solvency II whenever I'm on a platform like this. We definitely like the advice guidance divide to be properly looked at so that we can play a bigger role in helping individuals to build that financial resilience that they need for the future. But it is a spirit of partnership with government, I think, that we want. And I think if we can continue to develop those sorts of relationships that the Conservative Party has traditionally wanted with the financial services sector, will ensure that we have a regulatory and a broader public policy framework that will enable the city, London and the rest of the country to continue to grow and develop and make our contribution to growth. Thanks, Paul.
Mike, thank you very much. So let's have some questions and some dialogue. Jerry, I just want to ask one that picks up on the events of the last week, which is about pension funds. So, to my simple way of thinking, when there's a market pile-on, it's like watching a kind of virus at work, probing for a weakness that you may not know is there. And what seems to my simple mind to have happened last week is that the market found that pension funds were reliant on a lot of borrowing to cover their short-term positions, and the bank had to go in and rescue them, and this may have been very heavily ventilated in the financial press, but I didn't see very much elsewhere about this risk in advance. So how big a problem do you think this was? What's the regulatory sort of solution, if anything? I'm turning to you first, but I'm very interested in what anyone else has got to say. And what did it tell us overall about the relationship between the government regulation and the markets?
Yeah, the challenge last week was in the wake of the mini-budget. It seemed that most, if not all, of the developments in UK financial markets were attributed to the mini-budget wrongly. For instance, global markets were moving quite significantly last week. The dollar, actually sterling did pretty well against the dollar last week, but the dollar has been strong across the board. Interest rate expectations globally have risen. So even if there had not been a mini-budget, it's likely that we would have seen significant movements in markets last week in the UK, because that's what was happening globally. In the case of the pension funds, I think it was the speed of the move on interest rates that triggered the problem. But this was a problem that was a shock, quite frankly. I wrote a piece in the Sunday Telegraph yesterday, and at the end of it, I cited Warren Buffett, who during the global financial crisis said that it's only when the tide is out you can see who is swimming naked. And things are unearthed as rates return to normal or as we move away from cheap money. Back in the old days, pensions are regarded, well, as safe as houses. How safe are houses, of course, that's the next issue. But pension funds would cover their assets and liabilities. It's, as it says on the tin, you have future liabilities, so you have your assets to offset your future liabilities. But because of the accounting mechanism involved, what we started to see is that pension funds have started to, or some, not all, bought derivative products from investment banks, where when rates changed, their collateral requirement increased significantly. So the pension funds then had to sell their assets to pay the collateral. The assets they had to sell were gilts. They were selling into a falling market, hence the doom loop. When some people saw it last week, this became to the fore. One comment in the city was weapons of mass destruction. Surely, if you had been aware of this behaviour, you would have tried to nip it in the bud. But it seems that the regulators were aware of it, didn't think it was an issue, and the Bank of England, it appears, was aware of it, and also didn't seem to think it was an issue. But bizarrely, the financial industry and the fact that you have, shall we say, pension funds should be very long-term in their thinking, but we've created an environment where they too have become very short-term, and they have basically taken on derivative products to actually effectively boost their returns and to boost their, is more accounting than anything else. But it was a pro-cyclical development, shall we say, that was unnecessary. And I've got a call at midday with someone from the pension fund industry who's going to run me through it, because I asked them to. But it was behaviour that led some pension funds years ago, as it's now clear in the press, to draw this to the attention of the regulators, that it was seen as unsafe practice, or my words. Did that make sense? Basically, they were doing things we didn't know they were doing, but seemed to be accepted within the industry. And effectively, if we look at 2008, we identify risks in the banking sector. We now seem to have risks elsewhere in the financial industry. The risks seem to be very concentrated, but over and above all that, the move away from cheap money, particularly in the wake of recent events, interest rate expectations not only adjusted, they adjusted dramatically. And I think it was the speed of the movement as well as the scale of the movement that really brought these problems to the fore. But they were problems that maybe should make people worried about different parts of the system. And the one area you would not expect there to be any problem is in the pension industry, because it is very safe, it's long-term, your liabilities are predictable, your assets are predictable. But just because of the way the accounting is done, we have this perverse situation in terms of them, many in the industry buying derivative products.
Anyone else on it? Because it doesn't sound from your account as though this is wisdom after the event, as though the bank and the regulators have not necessarily made the right decisions, or as Dominic Cummings put it rather crudely on his blog, I won't quote him exactly, he said, I think all this S blank blank T was meant to have stopped after 2008. Right.
Yeah, before 2008, the regulators thought the problems were in the hedge fund industry. Basically, where they look is not always where the problem is, and then they sort out the problem. But it's a combination of factors, but by all accounts, they were, shall we say, they were talking in very anonymous terms here. But once regulators and the central bank became aware of this practice a few years ago, I personally would have thought that they would have wanted to have looked into it in more detail, because it was quite clearly something that was going to come to the fore when interest rate expectations and interest rates rose. And we have had an environment of artificial, well, cheap money for 14 years now, and money, the price of money needs to normalise globally, not just in the UK, which effectively means higher interest rates.
Anyone else?
I've not got much to add to what Gerard's run through, I think, very well. Only to say that actually this goes back, the roots of this go back some way. It goes back, indeed, you could push it back to the 90s. And it is a kind of classic example of what's called the waterbed effect in regulation. So a lot of this was about pushing back on problems that had come up previously, and it has led to other issues arising subsequently. There's also been a move to looking at taking pension fund assets, marking them to market. It's also worth bearing in mind that often doesn't account for the fact that, particularly when you're looking at life insurance products, it's a 30-year promise that you're making to somebody that you'll pay them an annuity in 30 years' time. So to a certain degree, the historical approach of life insurers was whether your investment is actually underwater 5 years after you've made it isn't the important point. The important point is, do you get more money back after 30 years, and does that pay for your retirement that way? But regulators weren't entirely comfortable with that, particularly in Europe. That's one of the hearts of the problems that we had with Solvency II and the impact that had on the annuities market. So there's a sort of broader picture that we need to look at beyond just LDIs about how all of this fits together. In terms of the other points that Gerard raises, I think on the dollar, I mean, the dollar has just crushed all before it for some months now. So the pound is not, sterling is not unique on that. And I'm old enough to remember that about 12 months ago, we had articles talking about the end of the dollar as the global reserve currency. That certainly doesn't look like the case at the moment. What I would say, though, is that the reaction to the budget does go broader than just the wider international turmoil that has existed. And certainly in some of the conversations that I've had, both here in the UK and I was in the US last week, I think markets were surprised by some of the scale that they hadn't anticipated. I think they were therefore reacted to that in the way that you would with any country that would do that. I think it's also important that we hang on, and this has been touched upon in this panel already, that we don't step away from the institutions that markets see as guarantors of stability and of an impartial approach to economic policy.
Anyone else? Yep, no, good. We'll start there. And anyone else? Any other hands? Yeah, there's one there. So 1, 2.
Okay, thank you. My name is Eleanor Cox. I'm a counsellor, but also I run a debt finance team at Lloyds Bank, looking after small businesses and medium-sized businesses. So I was very interested when you talked about the Macmillan Gap and that there was a 22 billion funding gap for small business. Obviously, the effects of ring fencing, bank ring fencing, mean that we have a responsibility, obviously, to the shareholders, but also the taxpayer. So I'd just be quite keen to hear what can banks do, but where do you see the growth coming, and where do you see that gap being filled?
Okay, and there, yeah.
Good morning, Andy Forster from Hull. Just wondering, very quick question, is it time to maybe do some stress testing on pension funds? I probably never thought it's required in the past, but maybe it is.
Okay, right. So who wants to go first? Teresa?
On the latter point, yes, I think there probably is some case for stress testing on pension funds. I think one of the perennial problems of any regulatory system is it tends to be focused on the previous crisis, but I think we need some fairly rapid moves to try and address the problems that Gerard has been talking about in relation to pensions. On the first question, I didn't quite understand what the question was. It was very rapid. You're talking about the inability to finance small businesses, is that right?
22 billion funding gap that was mentioned, and I was saying, where should that be filled? So who should take the responsibility or have the appetite to provide that financing?
Funding gap for what?
So it was a point Gerard made about small firms can't access finance, so they're missing out on 22 billion.
Oh yeah, okay. Well, I think one of the important changes is what the Chancellor's already announced about the charge cap, so that that pension funds and other big funds can more easily invest in smaller businesses and start-up businesses.
So who?
Thanks. On that first question around the funding gap. I mean, the first thing I'd say, I think, is that we must differentiate between different types of small businesses. The small business sector we often tend to think of as being one homogeneous mass. There's an enormous amount of variety there, from the family-owned small operator, small retail, simply looking for finance to keep the show on the road, to keep the business ticking over, through to very, very innovative, very exciting, high growth potential, tech-based companies that are on a very different trajectory and have very different funding needs. What we need to put in place, and I think what the financial services sector in the UK is capable of putting in place, is a variety of solutions that meet all of those different scenarios, both the type of the company and where they are in their growth story. I think on the lending side, we have seen in the UK a pretty impressive growth in direct lending funds, in private credit funds, filling some of that gap that has come from the banks. And there's a huge wall of capital to be invested through equity into those high growth potential companies. It's something we do a lot of at M&G. Our Catalyst Fund is particularly focused on smaller companies that are in the sustainability and responsibility space. What we need is a public policy framework that will continue to encourage that capital to come. I mentioned in my opening remarks how we want to unlock some of that retail money that's sitting in bank accounts earning very little, get some of that invested into the market, and thereby providing capital for these sorts of businesses, and unlock a little bit more of the institutional capital. So the pension charge cap reform that the Chancellor announced a week and a half ago, I think, is a really exciting opportunity. But we need to get from the announcement to the actual delivery of the regulatory change to the actual capital flowing into the funds and then through to the companies.
Just a few points. There's a whole combination of issues. I think in any discussion about the financial sector at the moment, moving away from cheap money has to be centre stage. 14 years of low interest rates has led to rampant asset price inflation. It's led financial markets to not price properly for risk. It's led to an inefficient allocation of capital, including zombie firms being allowed to survive and lack of money being directed to potentially productive firms. And it's created an environment in which inflation has taken hold. On top of that, it's led the Bank of England to be seen as the shock absorber whenever there's an economic problem, as opposed to focusing on supply-side longer-term reforms. So moving away from cheap money is a given. In terms of the funding gap, whenever the UK Treasury discusses this, or certainly when they had their two previous guys in charge who are no longer there, they used to view it as a demand-side problem, not a supply-side problem. But you can get yourself in a circular debate on that. When it comes to the banks, yeah, reforming ring-fencing would seem inevitable or necessary. Banks often say they're incentivized to lend to the housing sector and to buy government debt, in which case one needs to look into more detail on that. In terms of the mini-budget, partly because of the shenanigans over the top rate of tax, lots of good aspects of the mini-budget, which shouldn't have been a mini-budget, which should have only been a fiscal statement, lots of bits of that in terms of EIS and all that was very good, and I thought quite positive. The other part is that if people, the general public were in the debate now, they wouldn't just be talking about small firms, they'd be talking about housing and finance for housing. Because always the debate on housing is about new supply. Reducing stamp duty is important because it changes turnover. But in terms of finance, that's a big issue. And the government often has intervened too much in the housing sector. And basically, the mortgage market has the ability to really be transformed if you allow other international players into the market. Banks want to lend longer term but medium risk, loan to value up to 75%. Pension funds are quite prepared to take on loan to values of 75 to 90%. Investment banks are quite prepared to take on loan to values of 90 to 100%. You can actually have bespoke mortgages where you would still go to the buy it in the same way, but behind the scenes you have a very complex system. But that market is developing, but every time it gets a new lease of life, government intervenes to try and help. But the market mechanism can provide the solution in the mortgage market. And I've written about that for Policy Exchange, but that's a key area as well. So the general public often thinks about housing as the area the financial sector should be sorting out, although debate here is always about the corporate side, I would say. Hope that helps.
Just briefly, I think this point about the Macmillan Gap is a really important one. I think it's the critical question, and I'm probably going to say something slightly unpopular here, which is that it's been a critical problem for 90 years. I mean, 3 generations have gone by. This was first looked at in the 1930s. We have not fixed this, which would seem to suggest that there isn't an easy regulatory or tax or legislative fix here. The problem, I think, is predominantly cultural. And you look at that, one thing that I point to as a piece of evidence for that, you look at the approach in, say, Germany versus the US versus the UK. So if you're a small company and you're looking to grow in Germany, the chances are you go to the local Sparkasse and the local bank and you get a loan. And that's what 80% of German companies do. 20% roughly go for equity finance. So they'll sell shares in the company. Because in Germany, the culture is you borrow from the bank, you invest and you grow. If you are forced, and this, I'm sort of keeping this at a very summarized level, but if you are forced to go to sell parts of your company, that is seen as a failure. In the US, it is literally the other way around. It's 80-20 in the other direction. Because in America, if you've persuaded somebody to invest in your company by buying its shares, you've made it, you've won. You are a winner. You've not had to go to the bank in order to get financing. In the UK, interestingly, it's 50-50. It's literally 50-50. There's also a reluctance in many cases, particularly with family-owned firms, you'll know this from your business, to sell what they see as control by selling parts of the company to strangers or people outside the family firm. So there's a huge issue here. And I think part of it is about us changing the culture in small businesses here in the UK, and that's an education program over the long term, as well as within the industry itself, and I think industry absolutely recognises that. It's about looking at innovative ways of doing this. But it is very difficult to stand up at a dispatch box and say we're going to change the culture over 20 or 30 years, because that's what it may take, and which obviously goes beyond the life of a single government, needs changes in how regulators approach these things as well, quite candidly. It is far easier, I'm afraid, to stand up and say we've got a terrific idea, it's a magic bullet, it will fix it, and then year after year after year, government after government after government do the same thing. And I think this is a much more deep-seated issue within the UK economy, which is frustrating because we have a really exciting, really vibrant group of small companies that we need to drive. A couple of other quick factors. I think there are other issues here that once you reach a certain scale, sometimes you look beyond the UK for investment, and that's a valuations thing. So the chances are, frankly, if you go to the US, you are going to get more for your company if you're selling it than you do in the UK. Again, we need to look at how we do that. There's a lot of really interesting work that Lord Hill, Mark Austin and others have taken forward on that. And then the other is, I used to work at one of the UK's biggest banks. We did some research into this. One of the factors that slows companies down, makes them think twice about hiring people, is regulatory burden. As small companies see it, red tape. So how do we make sure that companies recognise, firstly, that a lot of this is about supporting companies, not about hindering them, but where there are things that slow companies down, how can we look at that in a different way?
So we need another 2, lots of hands going up. And take the gentleman there and the gentleman there with the grey hair. Yeah, I'll take you. Yeah.
Good morning. I'd like to change the focus of the discussion a bit and perhaps talk about exports. I'm Andrew Seaton. I'm the Chief Executive of the China-Britain Business Council. Now, I know it's a brave man who mentions the word China at a Conservative Party conference, but the fact is that it's the second biggest economy in the world, and it's somewhere with which we just need to have sensible economic and trade relations for our own self-interest. The question really relates about what more we could be doing to project the UK financial services industry into China and across Asia. The fact is that in the coming decades, that is where so much of the world's wealth creation is going to be. This rising middle class you see across Asia, 4/5 of that in China. China already accounts for about 1/3 of Jaguar Land Rover sales. Chinese consumers love their Range Rovers, they love their Burberry. They're now moving with their savings, looking at where they're going to be investing their savings, looking at buying financial services products, life insurance, so forth and so on. Our competitors, who have similarly difficult political relations with China, are not holding back. The American financial services companies are in that market in a big way, the French financial services likewise. And at a time when it's more important than ever to be boosting our growth, when financial services are an absolutely key area of the UK's competitive advantage, is there more that we could be doing, perhaps in partnership between government and the financial services industry, to make sure that as those Asian consumers are looking in the next 10 years about where to buy their financial services products, they're looking here and not New York and not Zurich. Thank you.
So, over there, yeah.
Thank you. Good morning. And forgive me if you've covered this, but is my simplistic understanding that the Bank of England had to step in to prevent the meltdown of pension funds correct? And is that, to a large extent, an issue of the pension funds, frankly, investing in derivative products that they probably don't understand? I think back to credit default swaps. Thank you.
All right. Do we just want to quickly go back again over pension funds? I mean, was it a meltdown?
Yeah, this is as much an accounting issue in terms of the practices of some, not all, some pension funds. It was LDIs, as it's called, liability-driven investment. So they were taking these positions to protect their future liabilities in their mind. But by doing it, they were incurring risks that were not there if interest rates were low, predictable, and not changing, but risks that became very apparent. The Bank of England didn't have to rescue the industry, so they provided a facility of 65 billion. In fact, the markets dubbed it quantitative confusion last week. Last Thursday week, the evening before the mini-budget, the Bank of England had raised interest rates by 0.5% when the market thought they would do 0.5% but had hoped for 0.75%. But the bank also that Thursday said they would engage in quantitative tightening involving selling gilts and 80 billion over next year. The market had hoped they wouldn't because we were already about to see the normal debt management office issuance of gilts. We were about to get new gilt issuance as a result of the mini-budget, or whatever you want to call it, because of the energy levy. And then on top of that, the bank was about to sell. So quantitative tightening happened. Then last week, the bank said that they would buy gilts as a result of this, but made clear it was temporary for financial stability reasons. I think they said they would buy 5 billion a day. It's reported they only used 1 billion of that facility on the first day. So I think it was as much the reassurance that they would be a stop. When people see a doom loop as such, they keep selling. So the industry wasn't, it was solvent still, but we have a situation where practices, and the gentleman's question over there about stress testing comes to the fore. But some in the industry would argue that it was necessary or acceptable behaviour, but as we've seen, there are clear questions about it. I'm happy to talk about China as well, but maybe Teresa wants to say.
Let's have Teresa on China, and then I know you did a column for us about China, so you've got lots of thoughts on it. Let's just have Teresa briefly.
I mean, you asked the big geopolitical question at the moment, you really do. And it's one that I've sort of grappled with in wearing another hat as a member of the Intelligence and Security Committee. Oh. The reality is, whilst, you know, as you say, many of my colleagues are very worried about the security threat posed by China and its human rights record, and we must be clear-eyed about our relationship with China. Absolutely, we must continue to hold them to account for their human rights abuses, and we must be doing all we can to prevent the theft of our intellectual property. But at the same time, we need to do business with them because they are an economic superpower, which is only going to get bigger, and the vast opportunities for trade in financial services with China are too big to be sacrificed. We have to find a way to engage with China which in which we do all we can to protect our own security and our own property, in effect, but also delivers on those opportunities for financial services, and that is a key task for ministers and for regulators, and certainly I personally will be engaging to try and make sure that we get that right.
And is this, just before anyone else comes to, is this actually what's going to happen? Because Liz Truss is seen to take, a much tougher stance on China than her predecessor. You'll know there was a lot of argument in the strategic review about exactly what should be said about China. China wasn't placed with Russia as a threat on the same strategic level. It now seems possible that it will be. You don't do business with countries that you have declared are committing genocide, which Truss has come very, very close to. So it's just in the light of that, I'm turning to everyone else on the panel to ask what they think. So we'll do Miles and then Jerry and...
So very briefly, in the interest of time, completely agree with the points that Andrew said and that Teresa's made. I think there's also a bigger picture here as well, which is the UK financial services and professional services industry is successful because this is an international market and we are amongst the most internationally open countries in the world. The UK has long been a champion of free trade internationally. If I have one concern at the moment, which I think has a particular bearing on the UK, is that we are heading for a period of global economic and regulatory fragmentation. And we are particularly exposed to that because of our need to attract and work in larger markets. Very, very briefly, as an example of this, there are three major powers in the world when it comes to fintech: the United States, China, and the UK. The US and Chinese markets are much more inward-looking because those are vast internal markets. The UK is successful because we export and look outwards, and we need to continue to do that. So avoiding regulatory and economic fragmentation is critical to our industry's success and the UK's long-term success.
Michael and Joe. Michael.
I mean, very briefly, on China, every company, whether in the financial services sector or any other part of the economy, has constantly got to balance off three different components. The commercial potential of the Chinese market, which, for all the reasons that you outlined, we know is absolutely huge, including in financial services, including for things like asset management. You've got to balance that off against the reputational risk of being active in China in other markets, because we do know that customers, clients, shareholders care about where it is that we're doing business and who it is that we're doing business with. And the third factor to be balanced off is the political risk. This is a regime that is not like other regimes in which we operate. Different companies, frankly, will come out in a slightly different place on that, depending on the mechanics of their own operation and just their own sense and feel of where the balance ought to be. So I don't think you'll see a single definitive attitude or approach towards China from the financial services industry. I think each firm will find that balance in a slightly different place.
Yeah, 3 points. First, in terms of China, I would argue we need to have a clear red line or blue line, whatever colour the line is you want. On one side is defence, security, intelligence, telecommunications, and as Teresa touched on, intellectual property. The other side of the line is business and finance, and let business and finance get on with it. America seems to be able to have a hard line towards China, but American firms are all over China. So we need to be realistic. Second, the Prime Minister, when she was Foreign Secretary, I thought did a tremendous job in terms of positioning the UK in terms of the CPTPP, the Comprehensive and Progressive Trade Agreement in Asia. And I think we can leverage off that. Japan is a country we should be encouraging to invest here big time. Japan has a rapidly aging population. It's seeking to diversify. A weaker yen is partly a reflection of that. We should be opening the doors to inward Japanese investment and just courting them because they have a phenomenal amount of money. Third, the fragmented environment is very interesting. When the Ukrainian war broke, one of the seismic events was freezing the reserves of the Russian Central Bank, which was seen by people in the financial markets as probably the equivalent of not recognizing the sovereignty of an embassy. it was seen as changing the rules of the game. And after the Ukrainian invasion by Russia, we effectively have seen a G3 world, but not the G3 world people might have thought about. It's America, its allies, China and its allies, and the non-aligned countries, many of which were Commonwealth countries, India, Pakistan, and bulk of Africa. And this matters because I think it reinforces the benefit of London or the UK having its own regulatory environment, because those non-aligned countries don't want to alienate China, they don't want to align with the States. But if we become more competitive and play it like cricket, straight bat, then I think we will do very well.
Great. Okay, we're beginning to thin out a bit, so I'm going to take a last three, and then we will be done. So I'm going to go there, and somewhere else. The lady there. Yep.
Melissa Collett, Chartered Insurance Institute. The panel talked about the role of financial services driving growth. Can the panel expand upon the role of professional services in driving growth, and is more self-regulation the answer?
Okay, and who was it? Yeah.
Thank you. Riccardo Tordera from the Payments Association. We spoke about China, the digital one. We don't have a digital pound. Do we really want to use the digital one to do trade? Very soon they will force it through all the Belt and Road Initiative countries. So this is going to be a threat to what is the role of the UK payment system. And on the other side, we have the European Union that's done good legislation on MiCA, but we could do better with the use of regulatory arbitrage in the UK. But a part of the announcements that we want to become a crypto hub as a country, there is not much on the ground. So what's the government going to do on that?
Okay, and the lady there. Yeah.
Catherine Kennett from the Chartered Insurance Institute also. Given all your presentations, do you think the future regulatory framework and the financial services market bill should be delayed to consider, to put in other considerations for growth and with regards to the regulation red tape?
Okay.
Thanks. I'll pick up on that last question around the FRF and the bill. There is absolutely a temptation to think that in a world of scarce parliamentary time, when this is probably the biggest financial services bill that we'll have for the next 5 or 10 years, that we should do it once and try and get everything in. But there's an awful lot already in the Financial Services and Markets Bill that we have been working on, asking for, advocating for quite some years now. We've been working on Solvency II reform ever since Solvency II was adopted, we've actually been pressing for reform. We need to put in place a new framework that distributes the power to regulate our industry post-Brexit. I don't think that can wait, frankly. So while there is an awful lot more that one could put into the FSM bill, I think we're better having half a glass than waiting for the full glass. Briefly on professional services, I think my answer would be similar to the comment that I made in the opening remarks about the role of financial services. Our job is as an enabler for the rest of the economy to be able to function and to be able to deliver that growth that is so desperately needed. And I think that applies as much to the broader professional services industry as it does to financial services. On the question of whether its regulatory framework is appropriate, I'm sure there are others in the room that are much better qualified than I am to comment on that.
Right, any of those three? Miles.
Very briefly, completely agree about the role of professional services. This is a symbiotic ecosystem. Financial services, professional services, incredibly closely intertwined. The role of the UK, for instance, as a major legal centre internationally is a massive advantage for the financial services industry and vice versa, the role of professional services as well. So completely agree with that. On the question regarding digital currencies, we need to strike the right balance here between making sure that we are innovative, that we're attracting companies, that we are continuing to be at the forefront of innovation, but without strangling that through regulation that's too restrictive or creating problems by having regulation that's too loose. I think that's something we're going to need to work through slowly over time. Different countries are taking very different approaches on this. On the Financial Services and Markets Bill. Completely agree with what Michael said, and that there's been a huge degree of consultation and reviews that have gone into this, and it would be remiss of me not to pay tribute to the work of the team at the Treasury led by John Glenn during that period. I think there's lots that we can do as that bill works through, but I think the important point here, as always, is to recognise this is an ongoing work. It is a work in progress, and it always will be. This is about evolution much more than it is about revolution.
I was going to say just one comment. Theresa's final comment in her opening statement about how EU law is starting to have supremacy over UK common law and how we need to push back on that. Your point on UK common law, I thought, is essential to all of this debate.
And on this, forgive me, I meant to mention professional services in my open remarks. I suppose I tend to sort of use financial services as an umbrella term, but we absolutely, it's professional services, both accountancy and lawyers in particular, are a huge asset to this country and a hugely valuable service export. So in all our focus on making the city an even bigger driver for economic growth, we need to take into account the needs of professional services. And in answer to the third point about whether we should put on hold the current bill, I think my answer to that would be no. Long experience in politics tells me that if the legislative train is pulling up to the station, you really need to get on it, because you never know when the next one is going to come. So it may not be nearly as comprehensive as we would like. It's much better to press on with what we've got at the same time as looking more broadly at regulatory reform in this area.
Well, look, everyone, thank you very much. It's been a fascinating discussion. It's gone all the way from the detail of financial regulation to future regulation, future relations with China, and that just shows how big and broad the financial services topic is. I'd like to thank Michael and Miles and Jerry and Theresa very much. Thank you.